Good morning once again. We have to start the class now. We've waited enough and we can't wait anymore. Let me start by saying we are all welcome to the last day of the revision for financial reporting at Ivy League. Today be the last day, according to the revision plan earlier shared with you. We should be revising group accounts, otherwise known as consolidated financial statements. That will be our focus mainly today. And there are two sets of questions we are going to use. We are going to use multiple choice questions, and we are going to use practice questions as well. Hopefully, during the second half of the class, we may do something new in addition, just to, when I say something new, I'm not going outside this topic. I just want to confirm something from you all, and subject to that confirmation, we may do something new, which will still be on group account. The question I'm projecting has already been shared. This document I'm projecting has been shared with you. Herein you have about 27 multiple choice questions. 27 multiple choice questions. And then you have two practice questions that we're going to look at, and we're going to finish all of them today by the grace of God. The approach is not to teach. The approach is really to solve questions. And solving question means we pick each question we solve together. Even though I have the study test with me here, not the study test, but the slide that we use in the class, I'm not going to go through it as if I'm going to teach. No. I will only make reference to it when the need arises, just to confirm that whatever I'm telling you is there in the slide I've used. And I believe you know that what you have in the handout, the study test, is more encompassing compared with what we have on this slide. So we started group accounts, if you recollect, by looking at some definition of important terminologies. Important terminologies. Thereafter, we looked at exemption from preparing group accounts. Under what circumstances are you exempted from preparing consolidated financial statements? Then we looked at explanation of control, which happens to be one of the terms that we defined. Thereafter, we looked at exclusion of a subsidiary from consolidation, meaning under what circumstances can a subsidiary be excluded from consolidation. We looked at uniform accounting policies. The fact that for the purpose of preparing consolidated financial statement, the accounting policy of the parent of the subsidiary should be aligned with that of the parent. And that may mean you have to adjust the financial statement of the subsidiary before you consolidate. We talked about uniform accounting dates, meaning the year end of the parent and that of the subsidiary should be the same. If they are not the same, you were told what needs to be done. You were told briefly that there's a standard called IS-27, which is separate financial statement. In that separate financial statement, when you have investment in subsidiary, associate, and JV, no, JV is not applicable at this level. At what value should it be carried? You have the option of using costs, which is the most popular one, in the separate financial statement. You have the option of using IFRS 9, which is not common. And you have the option of carrying the investment in subsidiary and associate in the separate financial statement using equity method, which is equally not common. The most common one is to carry it at cost. Thereafter, we started the calculation by looking at step-by-step approach of preparing consolidated statement of financial position. Here you were given about 8 rules, which I said will follow strictly in preparing consolidated statement of financial position. The only thing you saw thereafter was, as we progressed, we started doing a lot of working notes. As without doing working notes, we won't be able to deal with some of those things as they become a bit complex. Right. So thereafter, we looked at all necessary adjustments, intra-group adjustments, adjustment for intra-group balances. We looked at all of them, how to adjust for unrealized profits, on sale of inventory, unrealized profit on sale of PPE, receivables/payables between parent and subsidiary, inventory in transit, cash in transit, loan receivables/payables. We looked at all those intra-group adjustments. And we also looked at if you acquire a subsidiary during the year, how does it impact your consolidated statement of financial position? The only area it impacts is the examiner will not give you a retained earning at the date of acquisition. You have to figure it out yourself by calculating it. And to ensure we master this, we looked at several examples to really deal with this. Thereafter, we move to preparing consolidated statement of P or L and other comprehensive income. And we looked at that in detail as well. And all the intra-group adjustments that you will come across when you are preparing consolidated statement of P or L and OCI, including what happens when you acquire a subsidiary during the year. You will have seen that for the purpose of preparing consolidated statement of P or L, we don't consolidate for the full year, we prorate. Then, thereafter, we looked at associates, how to account for associates in the consolidated statement of financial position, and how to account for associates in the consolidated statement of profit or loss. The last thing we did was how to account for disposal of interest in subsidiary. At your level, I told you the disposal we'll deal with will only be the disposal of full disposal where control is lost. So those are the things we did, and you guys were asked to attempt a lot of questions. The more the questions you attempt, the more you try to confirm that you have mastered everything we did in group accounts. I believe you will have attempted so many questions between when we finished and today. So those are the things we did, briefly summarized, briefly revised. Before we go into the full detail of attempting the questions we have here, I would like to pause and give room for any comments, any questions. If you have any question, you have any comment, please feel free to raise your hand. Let's quickly do that in another 35 minutes before we start. Adedoyin.
Good morning, Mr. Jamil. Good morning, sir.
Go
Okay,
ahead,
so
so your
I just wanted
voices.
to, I just wanted to ask.
I
So,
really
okay, so I just wanted to find out, during this session, are we also going to be looking at associates, aside from subsidiary, and are we also going to be looking at associate? I tried a few questions on it yesterday. I think there are some things that I'm missing. So I was just hoping that, to be part of the things that we'll look at today.
When we say group accounts, we are going to include associates. Associate will be there.
Okay,
And feel free to ask any question when we are treating. There are many multiple choice questions we'll treat here just to affirm our understanding. When we get to that point that we are dealing with associate, feel free to throw in your questions.
All right, sir.
Any other comment or question, please?
Yeah, Mr. Jamil, when solving for this disposal of interest in subsidiary, and you're trying to calculate the profit or loss for this consolidated statement of financial position, I saw this question where instead of adding the net asset of the subsidiary and the goodwill at disposal date, they subtracted it and then they added the NCI at disposal date. So is there a reason for that?
Do you know what you've just described is exactly the same thing as what I did?
Oh,
This
really?
question you asked, this is not the first time I will hear it. It's exactly the same thing as what I did. Let me
But
tell
we're
you
not having the same
why
answer.
it's looking different from you. It must be the same answer if you use our format. Let me tell you, when I taught you, right, I used 2 columns. When I was calculating profit or loss on disposal in the consolidated financial statement, if you can open the question we solve, you will see that I used 2 columns. And surprisingly, I'm going to even solve a question on that today again, you will see it. I used 2 columns, right? The first column was where I put the process, the column on the extreme right, right? Then when I now said, when I get to net asset of the subsidiary at the date of disposal, I use the first column. I put that as positive, right?
Yes.
The second item is goodwill at the date of disposal. I use that first column again. The figure is positive. When I now get to NCI, the same first column again, but I put that one in jacket, which means I added goodwill to the net asset at the date of disposal. I now remove NCI from it, right? The net of those 3, I now extended it to the first column, the second column on the right, which is where you have proceeds. And that net amount, I put it in jacket, right? I put it in jacket, which means I remove it from the proceeds. Then that gave me gain on disposal. That gave me gain on disposal. What you have just told me is the one you saw, they put proceeds, right? They now remove net asset of the subsidiary at disposal date from that proceed. they remove goodwill from that proceed, then they added NCI. It's the same, but the one you were talking about, they use the same column for everything. Is that not?
Yes.
Check it out. It's the same. What I've explained in those two approaches are the same.
Okay.
It's the same thing.
Okay, sir.
Okay, any other question? Okay, in the absence of any question, let's quickly start with this multiple choice question. Doing multiple choice question helps to deal with a lot of principles. It helps to test many principles. And for each of these 27 questions, we will see they are not the same. These 27 questions you have here, for those of you that received lecture at Ivy League, 12 of them are new. They are questions you've never seen before, right? That is question 1 to 12. Then the remaining 15 questions, are we together? They are questions you've seen before, but I've not given you the solution. Those are questions 6 to 20 in the study test. So we are looking at them together. So making 27. Okay, so let somebody read the first question for us so that we can tackle it together. Anybody, please read it. Question 1.
Hi, Mr. Jamil. Good morning. Hello.
Good morning.
Please, I can't see your screen if you're sharing. And I've tried looking at it and I still can't see it.
I didn't hear this yesterday.
Sorry, I didn't get that.
I said this thing you just told me. I didn't hear it yesterday. I said, why am I hearing it today? For almost 5 hours yesterday, I lectured.
I don't know what's happening as well.
I thought network had changed our stuff from misbehaving until you said it today.
Thank you. I can see it.
Okay. Now. Okay, so who's reading the first question, please?
Good morning.
Good morning, Emmanuel.
Number 1, when a parent is evaluating the assets of a potential subsidiary, certain intangible assets can be recognized separately from goodwill, even though they have not been recognized in the subsidiary's own statement of financial position. Which of the following is an example of an intangible asset of the subsidiary, which may be recognized separately from goodwill when preparing consolidated financial statements? A new research project, which the subsidiary has correctly expensed to profit or loss, but the directors of the parent have reliably assessed to have a substantial fair value. B, a global advertising campaign, which was concluded in the previous financial year, and from which benefits are expected to flow in the future. C, a contingent asset of the subsidiary, from which the parent believes a flow of future economic benefits is possible. D, a customer list, which the directors are unable to value reliably.
And the correct answer is what?
A.
B.
B.
Let's start from elimination theory or principle. And let me start from behind. Let me start from D. Nobody is speaking D, right? Is there anybody who is speaking D?
Nope.
No. Customer list, no.
Are you
Not
saying
because
customer
of
list
that.
is not?
No, because it can't be valued
Because it can't value
reliably.
reliably.
Okay, thank you. So there's no point even checking out what I wanted to check out. At least you saw it when I mentioned in the slide that the acquirer is required to recognize intangible asset not previously recognized by the subsidiary. Are we together? If the fair value at the date of acquisition can be measured reliably. I was trying to highlight everything, but the thing refused. So you've seen those areas I was trying to highlight. If the fair value at the date of acquisition can be measured reliably. I get it. That is key. That is key. Okay.
So, sir,
Now,
if
if you say D, okay, I'm listening.
no, I was saying, so if it's not being able to be measured reliably by reporting by acquisition date, but by reporting dates, we won't include it.
I'm talking of acquisition date is what you saw there, right? You cannot replace that with any other date. Are we together? You can't replace that with any other date. Although there is something we call measurement period, which I'm not sure I taught you. Have you guys heard of measurement period in group accounts before? Has anybody heard of it?
No, sir.
Someone say yes.
No.
Okay. Because the question you raise is, you saw it in that slide that for you to recognize an intangible asset not previously recognized by the acquiree being the subsidiary, at the date of acquisition, you must be able to reliably measure that intangible asset at fair value for you to bring it into the book, even though it wasn't recognized. So the question you now raised is, what if you are unable to measure it reliably at the date of acquisition, but at the reporting day, you are able to do that? I say you can't replace that date of acquisition, right? But there's something called measurement period. But that measurement period could make you to recognize retrospectively what you discover within a period of 12 months after the date of acquisition. You can recognize it retrospectively. Are we together? Retrospectively, which means in the month 7 after the date of acquisition. If something you were unable to measure reliably 7 months ago, which is at the date of acquisition, you later discover month seven after the acquisition date, that now you are able to measure it reliably. Since it's still within that period of 12 months, which is what we call measurement period, you can adjust retrospectively and recognize it. But the fact that I did not teach you measurement period means it's outside the scope of your syllabus. You will only learn about that when you are doing strategic business reporting. So as far as we are concerned, we can replace that date of acquisition. Whatever you can determine that date is gone. So a customer list which the directors are unable to value reliably, no, because of unable to value reliably. So that one is out of it. It's out of it. C, a contingent asset of the subsidiary from which the parent release a flow of future economic benefit is possible. We've never talked about contingent asset, right? I told you about contingent liability, right? That is what I told you. You saw it here on this slide, right? This is a contingent liability. I never told you anything about you being able to recognize contingent assets. So that means, again, option C is not correct, right? Let's now move to B. A global advertising.
Sorry, sir. Sorry, sir. Before you move on that contingent asset, so I just want to understand why, the parents, we are not consolidating. Is it because naturally, basically, when accounting is concerned, we're always very prudent. Is that why you can't recognize a subsidiary's contingent asset in your own when you're consolidating, or there is another reason for it?
Okay. You did IS 38, intangible asset, right? Sorry, IS 37, provisions, contingent assets, and contingent liabilities. Right? Did you do it?
Yes.
We're not talking now.
Yes. We always disclose it there now. Yes,
What
you
did they
did
tell
it.
you about? What did they tell you about contingent assets
You
there? What did they
disclose
tell
it.
you about
You
contingent assets?
disclose it. You disclose it.
Are you sure? Are you sure they say you should disclose contingent assets? No, that is not what you were told. Even though I wasn't the one that taught you. Let me tell you what you were told. Provision that meets the 3 criteria, you recognize it. That is number 1, right? Contingent liabilities, you disclose it unless the probability of outflow of economic resources is remote. It's remote. In which case you don't disclose contingent liabilities. Contingent assets, don't even disclose it. That is what you were told. If I want someone else to tell me what I've said is not what you were told.
No, that's what we were told.
They never asked you to recognize contingent assets in IS 37, right? Okay, so we are now talking of group accounts where a parent acquired subsidiary, right? The standard that deals with that is IFRS 3. That standard tells us specifically that contingent liability, as long as the fair value can be measured reliably at the date of acquisition, even though the outflow, it is not probable that an outflow of economic resources will be required, contingent liability, please recognize it. And it also talks about intangible assets. Are we together? But the standard is, it talks about intangible assets, yes. But that standard, IFRS 3, never talks about contingent assets. So if it doesn't talk about it, what the standard doesn't say, we cannot begin to now bring it into the book. Already IFRS IS 37 does not even say you should recognize contingent asset. It does not even say you should disclose it. So if IFRS 3 is silent about it, right, then don't let us begin to now say why. If it is why, then that is another body of knowledge entirely. It does not talk about, it talks about intangible asset not recognized by the acquiree. It talks about contingent liabilities, but it never talks about contingent asset. So as to why, it's a big, if I start explaining it now, it's going to be a bigger thing. So let's leave that one.
Let's go on. Yes, let's go on.
So B, a global advertising campaign, which was concluded in the previous financial year and from which benefits are expected to flow in the future. I think, Emmanuel, you went for this, right? Or was it not you or someone else?
Yes.
Someone went for this.
Yeah, I went for
But
this.
what were you told in IS 38 when you did intangible asset? What do they say about advertisement campaign, advertisement cost? In IS 38, they told you that the following costs should not be recognized as intangible asset. They should be expensed. They mentioned about 4 or 5. Can you remind me of those 4 or 5? I wasn't in your class, but I know they will have mentioned the following costs. I'm not talking of the following internally generated intangible assets should not be recognized. That is not what I'm talking about. In IS 38, it says the following costs should never be recognized as intangible asset. They should always be expensed. Can you remind me about 4 or 5 items they mentioned there?
I only know research
One of
costs.
them. No, you are saying another thing. One of them is
advertising,
advertisement costs. Number 2, training.
Then I think training.
Number
Okay,
3,
yeah.
relocation costs, cost of relocating your business. Number 4, startup costs, the cost you incur before you start a business. Those costs, IS 38 specifically says, don't ever think of capitalizing them as intangible assets because they are not intangible assets. When you incur them, expense them. Are we together? The only thing that can make you to leave advertisement costs without expensing it, you know why? You know when? If you go to AI, assuming your year end run from January to December, right? You've now paid AIT to run an advertisement for you from October to March. That is 6 months, right? October to March, that is 6 months. By 31 December, that advertisement will have been run for what? October, November, and December, which is 3 months, right? Assuming you pay $6 million, then 3 months out of that 6 months, multiplied by that 6 million, which is 3 million, should be expensed. The balance of 3 million, because AIT has not run the advertisement for you, it will run in the following year, which is January to March of the following year. Are we together? That one, you can put it in where? You can put it as prepayment, but not as intangible asset, but as what? Prepayment. Because you have made a payment to AIT and it has not rendered the service to you. So you can put it as prepayment, prepaid expenses, and put it under asset in your SFP, but not as intangible asset. Now, if advertisement cost is not an intangible asset, are we together? And IFRS 3 that talks about when you acquire a subsidiary, what you should recognize. It talks about intangible asset. It never talks about any other asset, but intangible asset not previously recognized. So that rules out global advertisement campaign. So B is equally not a correct option. Then that means we are left with a new research project, which the subsidiary has correctly expensed to P or L, but which the directors feel have a substantial value, fair value. That is the only correct answer. That is the only correct answer. So A is the correct answer.
Hello, sir.
Hello?
Thank you. Thank you for the explanation. It's just that for me, you know, that when you were solving one of those questions, there was this intangible answer that we recognize, brand name.
Yes.
So,
yes.
But, I mean, brand name not gotten from advertising? I mean, they look to be similar. So that was what I was thinking.
No. If you go back to IS 38, there is something you were told there. They said the following internally generated intangible assets should not be recognized. You know, they refer to them as what? Intangible assets. But they should not be recognized because they are internally generated. There they mention brand. There they mention publishing title. There they mention customer list. There they mention masthead. Are we together? Can you remember you were told all those things in 1938?
Yes,
right?
I think
Yes.
it's on that slide.
So because brand was referred to as an intangible asset, is different from advertisement cost. I hope you know that now. So that means if an acquiree has brand that it has not recognized, but you are able to determine the fair value at the date of acquisition as the acquirer, you have to recognize that brand as part of the asset of the acquiree. I hope that is clear.
Yes, sir.
Hello, sir.
Hello. Hello. I'm with you.
Please,
Go
sir,
ahead.
aside this particular answer, sir, are there any other example of an asset that can be recognized aside from the intangible asset recognized by the subsidiary on consolidation, so that one can take note of it,
It's
sir.
typically intangible assets. Intangible assets not recognized by the subsidiary in his book. Because I-38 prevents recognizing such intangible assets, it is only those intangible assets that you should bring into the books as the acquirer at the date of acquisition, provided you can determine the fair value reliably as at that date. And that was what knocked out D. D will have been correct, if not that they said the fair value cannot be determined reliably. D will have been correct. So it's only intangible assets. Someone was trying to ask a question again.
Yeah, it was me. So, thank you for the explanation. I just wanted you to shed more light on the research cost. You know, typically when we hear research cost, it already says you should not capitalize it. It hardly even calls it an asset. It's development cost that you can at times experience and then at times capitalize. So I don't know. I would have been left with that, but can you just explain why in this case research cost is now worthy to be called an intangible asset?
You are right. I understand what you are talking about. In I-38, they never referred to intangible assets as a cost, they never referred to research cost as an intangible asset. Rather, they refer to development cost as an intangible asset, provided those criteria are met. I understand what you are talking about. However, the fact that it wasn't referred to as an intangible asset in I-38 does not necessarily mean it's not really an intangible asset. It's because I-38 outrightly says research costs should be expensed. And because it has given that clear guidance that it should be expensed, so we do not have the time to be debating whether it's an intangible asset or not. It clearly says expense it. That is the reason there is no room for debating whether it is going to be an intangible asset or not. So what you've been told in I-38 remains so. Research costs must always be expensed. However, in business combination, when one entity acquires another entity, IFRS 3 permits that research cost that has been expensed, because I-38 says so, it has been expensed by the subsidiary. If you are able to place fair value on it at the date of acquisition, you, the acquirer, please recognize it. So IFRS 3 supersedes whatever I-38 might have told us. I hope that is clear.
Yes, it is very clear. Thank you.
So, sir, if I get you right now, sir. So the main reason why we are choosing the option A is because it can be measured reliably.
Exactly. Which was what I took you back to the slide to show you that such intangible asset must be, recognize it if the fair value can be measured reliably at the date of acquisition. So never lose sight of that. That is the main thing there. Never lose sight of that. That is the main thing there. Let me use this column for. Okay, so the option there is A. Okay, let's look at B, please. Question 2. Yes, we need to be fast. Okay, and I want to solve all the 27 questions with you. And I will still go and do practice question. Okay, question 2, who is reading for us? Emmanuel, I'm sure you are not tired. You can continue. At least you'll be able to do up to 10 before you get tired.
FOCCO owns an 80% investment in SpoonCo, which it purchased several years ago. The goodwill on acquisition was valued at $1,670,000, and there has been no impairment of that goodwill since the date of acquisition. On 30th September 20X4, FOCCO disposed of its entire investment in SpoonCo, details of which are as follows. Sales proceeds of FOCCO's entire investment in SpoonCo, $5,580. Cost of FOCCO's entire investment in SpoonCo, $3,720. Immediately before the disposal, the consolidated financial statements of FOCCO included the following amounts in respect of SpoonCo. Carrying amount of the net assets excluding goodwill, $4,464. Carrying amount of the non-controlling interest, $900. What is the profit/loss on disposal before tax, which will be recorded in FOCCO's consolidated statement of P&L, profit or loss for the year ended 30th September 20X4?
Thank you very much. You will recall that when you were taught the disposal of interest in the subsidiary and how to calculate profit or loss on disposal, I gave you two formats, as you can see here, right? This thing is slow. It's slow, I don't know why. It's not supposed to be this slow. So this was where we did it. We say calculating profit or loss on disposal in the separate financial statement. This is not what they are asking, right? They are not asking for the purpose of separate financial statement. The one they are asking is the second one here, right? Which is calculating profit or loss on disposal in the consolidated financial statement. We're not given tasks, so we will end it at gain on disposal, right? We'll end it at gain on disposal because we're not given tasks. I told you then that if you were given tasks, then before you can do this B, this calculation in B here, you must have done the A, because the task to be used here is exactly the task in the format A. But we're not asked. And just like I was explaining to you then, the person that asked, I used two columns. Right? If you are using a single column, that means the first item, net asset of the subsidiary, if it's going to be in this same column, they must wear jacket. Goodwill must wear jacket. Then NCI that did not wear jacket here is the only, that wear jacket here is the only one that will not wear jacket here. Because you can see that when I sum up these three figures, I extend it here in jacket. So that is what I was explaining. It's the same thing with what you saw. It's just that they use a single column, while I use two columns. That is why I always tell people, if you get used to a particular way of doing the working note, use that to solve any question. It will work for you. But by the time you are reading a test, a study test, or you are watching a video, if they use another format, you may not know that that thing they've done using another format for the working. You can use the format you are used to arrive at the same thing. But people get confused. Don't get confused. Don't get agitated. Just calm down and use the format you know. And you will see that the result will be the same. Okay, you've seen that to calculate profit or loss on disposal, we need just three items. Oh, sorry, four. Proceeds, which we were given in that question, net asset of the subsidiary, goodwill, and NCI. And that will take us to gain on disposal. I'm sure we were given all the four items there. We were given all the four items. So let me go back. Please take note of the figures for me, as I don't want to come back here when I get to the Excel now. So you have the proceed as 5580, right? You have the
Hello, Mr. Jamiu. Hello,
hello.
sir. I'm sorry,
Yes.
I can't see the screen again.
Is it because today is Sunday or what?
I really don't know. I guess it's just network.
But we can see Mr. Jami's screen. You just took it off now.
I can't see
I'm
it.
trying to. It's your network. It's your own network. Oh.
Agreed, sir.
I don't know which network you are using.
Is that TLO?
An MTN is the best, though. Maybe it's your
Mr.
location.
Jami, who says so? All the best.
Maybe it's your, your location can affect it. So we have the proceed, 5580. We have the carrying amount of the net asset, excluding goodwill. They said the following amount in respect immediately before disposal. That is at the date of disposal. The consolidated financial statement shows the following. Carrying amount of the net asset, that is what I mean by net asset at the date of disposal, 4464. Goodwill, is it given? Yes, 167 up there. You have it.
Oh, yeah. I was looking for it.
And there is no impairment, 1674. And the last thing is NCI at that date of disposal. You can see the man gave us all the 4 items. Please follow me to the Excel. I don't want to come back to that place. So I simply say profit or loss on disposal in 4 consolidated financial statement. Allow me to abbreviate, right? Okay. All figures there are in 1,000. There are some of these questions I will ask you to do for me. Okay, so we have proceed, right? You remember that figure is 5 something. You have the question with you, just 5580. The next thing is net asset of disposal. Sorry, net asset of subsidiary at the date of disposal. So I'm using first column. You can try the other approach, you will see that it will give you the same result. So can you remember what the figure is? It's 4,000 something. 4464. 64, right?
Yes.
Yes.
And we have goodwill at the date of disposal. Right?
1674.
1674. Then we have NCI at the date of disposal.
900.
That is going to
jacket.
Yeah.
So sum up the equal minus, because I want it to be minus. And close the bracket. That gives you 5. Then the net result is going to be profit on disposal.
324.
Right?
342 rather.
Which is this figure and this figure. That is 324. Do we have that as an option?
Yes.
Is it one of our options?
Yeah. 342. I think it's C.
Option C. It becomes another thing entirely. If what you have calculated is not there, I'm sure you'll be thrown off balance if that happens. Okay, question 3. Okay, question 3. Emmanuel, I'm sure you are not tired. Just let us know when you get tired. Okay, you are reading.
Consolidated financial statements are presented on the basis that the companies within the group are treated as if they are a single economic entity. Which of the following are requirements of preparing consolidated financial statements? 1. All subsidiaries must adopt the accounting policies of the parent in their individual financial statements. 2. Subsidiaries with activities which are substantially different to the activities of other members of the group should not be consolidated. 3. All entity financial statements within a group should normally be prepared to the same accounting year end prior to consolidation. 4. Unrealized profits within the group must be eliminated from the consolidated financial statements.
Okay. The options.
Option
A.
Option. Okay. Okay. Everyone can say it.
Okay, and the correct option is what?
3 and 4, C.
3 and 4.
Yeah, see.
Do we all agree? It appears no dissenting view, right? I would say question on what? Requirement of preparing consolidated financial statement. Like you said, option C is the correct option. Okay, let's go to question 4. Question 4. Okay, go ahead.
A parent company sells goods to its 80% owned subsidiary during the financial year, some of which remains in inventory at the year end. What is the adjustment required in the consolidated statement of financial position to eliminate any unrealized profit in inventory? A, debit group retained earnings, credit inventory. B, debit group retained earnings, debit non-controlling interest, credit inventory. C, debit inventory, credit group retained earnings. D, debit inventory, credit group retained earnings, credit non-controlling interest.
And the correct answer is
A.
I can hear A only from one person. We are 23 in this class, 24. Correct answer is what?
I think it's A.
A.
I think it's A. A.
Who sells? Parent sells, right?
Yes, sir.
When parent sells, there is nothing that concerns NCI in the unrealized profit, is that not?
Yes, sir.
It's only when the subsidiary sells that you can say NCI will have a share of the unrealized profit.
Sure.
So, and when you sell and make a profit, which is considered unrealized, group return has to be reduced and the group inventory has to be reduced. So the correct answer is A. That is what we've always done, right? Adjustments for unrealized profit when parent sells goods to his 80% own subsidiary, right? So the correct answer is A, as agreed. Okay, question 5. Question 5.
Cadico acquired.
Go ahead.
Okay, Cadico acquired 240,000 of Ambelco's 800 equity shares for $6 per share on 1st October 20x4. Ambelco's profit before tax for the year ended 30th September 20x5 was $400,000, and it paid an equity dividend on 20 September 20x5 of $150,000. On the assumption that Ambelco is an associate of Cadico, what would be the carrying amount of the investment of Ambelco in the consolidated statement of financial position of Cadico as at 30th September 20x5?
Thank you. And the correct answer is you cannot use eyes to control this one. You have to use your hand. Okay. I thought you would tell me the correct answer is this. Carrying amount of investment in Ambelco in the consolidated financial statement, right? Okay. Let me go back to that question. So it's our knowledge of associate that is being examined here. Somebody asked me a question on associate then. When I'm done with this question, when I'm done solving this question, you can bring whatever question you have on the floor.
This one was a bit clear too. But I'm sure we'll get that one that was struggling with.
Wait until we see the one that looks similar.
Okay, sir.
Okay, so, but don't forget.
Hello, sir.
Hello?
Hello, sir. Sorry to take you back, sir. Yes, sir. In the case of a subsidiary selling to another subsidiary owned by a particular parent, the unrealized profit for such, how will it be accounted for, sir?
First and foremost, I hope you know you will not see something like that in your exam.
Okay.
You will never see a situation where you have parents and two subsidiaries. In your own exam, you will never see. So first know that.
Okay.
So if you know that, that means the question you've asked me is either it's a real life question or it's a question that should be reserved for SBR. So I don't know, do you still want me to answer it or we should forget about it?
If you can answer it, sir, it's one part of the knowledge, sir.
Okay, but if one subsidiary sells to another subsidiary, from the group point of view, that is when you determine who is making that loss, right? Or who is making that gain? Who is making the unrealized profit? Assuming there are two subsidiaries, one has NCI of 20%, the other one has NCI of 30%, right? Parent owns both of them. We are preparing consolidated financial statement from the perspective of the parent, not from the perspective of any of those two subsidiaries. If The one that has NCI of 30% is the seller that makes the unrealized profits, right? The one that has 30% NCI is the seller that makes the unrealized profit. Parents, we're preparing that consolidated financial statement from the perspective of the parent. So when that subsidiary sells it, the unrealized profit it has there is 30%. So when you are allocating that unrealized profit between parent and NCI, you are still going to use that ratio 70-30, which is the ratio of the ownership in that subsidiary that sells. So you are not going to worry yourself about the ratio of ownership, which is 80%, 20%, in the other subsidiary that buys. So, which means it will remain the same with what you know. It will be as if that subsidiary, the NCI of 30% has sold to parent in terms of how it will be adjusted. It will be as if it has sold to parent, given that you are preparing consolidated financial statement from the perspective of the parent company. Even in SBR,
No.
examiner highly tests that.
I'm actually, the perspective at which I'm looking at it now, sir, is okay. For example, in terms of posting, will it still affect? So in that case, it won't affect the retained earnings, sir. Group retained earnings, will it?
Who says? Who says? Remember what we've always done before now. If we are doing a practice question, we will do net asset of the subsidiary. Is that not? That very
Yes, sir.
subsidiary that sells and makes that unrealized profit. That subsidiary that sells and makes that unrealized profit, it has NCI of 30%. Is that not? When we are doing the net asset of that subsidiary, we have 3 columns: at reporting date, at acquisition date, and post-acquisition returning. Assuming the unrealized profit after calculating it is 10,000, that 10,000 is going to be one of the items we will put in that net asset working note. We'll see unrealized profit on sale of inventory to another entity. We'll put it there in jacket, 10,000 at reporting date. We will not put it at acquisition date. Then we will put it in the column of post-acquisition return, 10,000 in jacket. That 10,000 in jacket, we have fed the overall total of everything we will have in the returning column, in that post-acquisition returning column. Is that not? It will affect it. It will reduce it. Then whatever be the total you have there, are you not going to share it between parent and NCI at the end of the day? You will share it between the parent and NCI at the end of the day, according to ratio 70% and 30%. So exactly what you are doing is that 10,000 unrealized profit used by me as an example, you are sharing it. It's affecting group account to the tune of 70%, and it's affecting NCI to the tune of 30%. So it will affect group returning only to the tune of 30%. And I mean 70%. And that is what we've always done. So it will affect it.
Thank you, sir. Thank you, sir.
Okay. So remember the financial statement day is 30 September 20X5, right? The associate here was acquired on 1st October 20X4. That means 1 year after, right? The profit after tax of this Ambel, which is the associate, is what? Is how did we even conclude that it's an associate? They said Caddy acquired 240 out of what? Out of 800, right?
Yes.
So
That's
that means
30%.
Yes.
I would like to do that here. So I would say percentage of ownership of Ambel by what? Caddy, right?
Yes.
That is 240 divided by 800. multiplied by 100, right? That is equal 240 divided by 800. I'll now put it in percentage, okay, which is 30%. So let me take this one and bring it down. Okay, so when you are using, when you are trying to determine carrying amount of investment in associate, right, using equity accounting, based on what you were told, the starting point is initial cost, right? Initial cost. Is that not? After that, you now say groups, either groups or use parent share. You can use parent share or group share, is the same thing. Parent share of what? Post acquisition return of who? Of the associate. If there's anything like dividend received, and I heard you when you talked about dividend, right? Dividend received, you removed it, right? From associate. From the associate. Okay, so let's go back there and look at what we have. The cost is not given on the platter of gold. We have to multiply something by something, right? This guy acquired 240,000. For what? They said for $6 per share on that day. That is the cost. So 6 multiplied by 240 is what gives us what we are looking for, right? So I will say equal 240 multiplied by 6. So the initial cost is that. The initial cost is that, right? Then the second thing is parent share of the post-acquisition return earning. Are we together? Let me go back and check. You said this one is straightforward. It's too simple for your liking, right? MBA cost profit after tax for the year ended 30th September 2025 was 400. You know, this amount is entirely post-acquisition return earning because this entity was acquired at the beginning of the year. And he paid an equity dividend on that on 20th September, 10 days before the end of the year, of 150, right? So we're going to say group share of the post-acquisition returning, that is going to be 400, right? Multiplied by 30, the percentage you have, that gives you 120. Then they pay the dividend. You will receive 30% of that. And that has to be deducted. If you go and look at the format of equity accounting, that is what we have there. So we say 150 multiplied by what? That 30%. So you are taking that one out. You are taking that one out. So, what did I do? No. So the summation of everything is 1515. 1515. Sorry, just to remind you, if you go to the study test, right? Sorry, not study test. This, you remember equity accounting? I'm just showing you, it's not compulsory, I should show you. Yes, you remember this. This is the format of how to arrive at investment in associate using equity accounting. It's just that you need to have all this thing in your head before you enter the exam hall. How can you have it? Is it by cramming? The answer is no. It's by solving plenty of questions. I know by now some of you will have dealt with so many questions that those questions are afraid of you. So this is the format. This format should be in your head before you enter the exam hall. It should be there. So let's go and look at the options we have there. Which one looks like the correct option for us? Option what?
C.
Option C. Option
Yeah.
C.
So, Mr. Jamie, let me ask, let it not be that it's just a coincidence that I got the same answer. So when I dealt this question, what I did was I got the normal percentage where we have done it. I got the initial cost where we have done it. But I then took 150,000 out of 400,000. I got a figure. I then multiplied that figure by 30%, and I got the same answer.
It's the same thing.
Okay.
It's the same thing. But why did you do it? Why didn't you do it that separately? Because in your own approach, that means we just have two items there. Initial cost. Then you now say parent share of the post-acquisition returning of associate after payment of dividend. That is what you have done. Those are the only two items. Is it due to lack of time that you did it that way?
I just assumed that was how to do it.
That is not how to do it.
I wasn't concentrating. I mean, I didn't look at that pro forma that he gave us. I just felt that, you know, based on head one ledger, that was
dividend received from associate is separate.
Yes.
It's separate. You arrive at the same thing, but learn how to do it separately.
Okay, sir.
Okay, question 6. Emmanuel, I guess you are not tired?
I am.
Emmanuel, you're doing 100 of this.
Mr. Jamil.
On first,
Mr. Jamil, you can ask the question.
Emmanuel, hold on. What is the question?
Does it not matter that the equity dividend was paid on 20th September as opposed to the 30th September that we have as a reporting date?
Okay. It doesn't matter. I don't know what you have in mind. Can you tell us? It does not matter.
I would have, okay.
I think
I would have prorated it or something.
Never. So that is why I say it's better to tell me what you have in mind. Ladies and gentlemen, what if it was paid half year? You still prorate it. What if it was paid second day after the acquisition, which is October, 2nd October? Never prorate it. So never prorate it. So if you tell me what you have in your mind, I will know how to deal with it. Never prorate it.
For associates, you don't prorate anything.
Yes.
Is that what you're saying? Okay.
You don't prorate it. And likewise for subsidiary, we don't prorate as well. When you are trying to eliminate, you know, for subsidiary, we eliminate on dividend received.
Yes, yes.
Okay, go ahead. Emmanuel, go ahead.
On 1st October 20X4, Pyramid Co. acquired 80% of Square Co's 9 million equity shares. At the date of acquisition, Square Co. had an item of plant which had a fair value of $3 million in excess of its carrying amount. At the date of acquisition, it had a useful life of 5 years. Pyramid Co's policy is to value non-controlling interest at fair value at the date of acquisition. For this purpose, Square Co's shares had a value of $3.50 each at that date. In the year end 30th September 20X5, Square Co reported a profit of $8 million. At what amount should the non-controlling interest in Square Co be valued in the consolidated statement of financial position of the Pyramid Group as at 30th September 20X5?
Thank you. What are they testing here? Our ability to calculate NCI. You know, based on what we've always done, in calculating NCI at reporting day, you use 2 or 3 items, depending on whether or not you have impairment loss on goodwill, right? But I'm sure in this question you read, there is no impairment loss on goodwill, right? So we just calculate 2 items. We need 2 items to calculate NCI. The first one is fair value of NCI at the date of acquisition, right? Is it given on the platter of gold? Can you see it? or is given on the platter of platinum, on the platter of silver. It's not given directly, right? But before now, you know how to calculate it if it's not given. Can somebody tell me how we should calculate or derive fair value of NCI at the date of acquisition? How are we going to derive it here? Because that amount is not given. I hope you guys can still hear me. Oh.
We can hear you, sir.
It's just that you are not talking. You are not responding to my question.
So, Mr. Adami, I can try, but I'm not sure.
But you know, we've solved a question like this in the class.
Yes,
This
sir.
one that you are saying, fair value of NCI at the date of acquisition. When the amount is not given on the platter of gold, something must be given. And you use that something.
The
We use the
3.5
share
euro.
amount, so you can multiply by the number of shares purchased.
Yes, that the NCI has.
Parent company is pyramid, right?
Yes, sir.
Subsidiary is point. The said parent company acquired 80% of 9 million equity shares of pyramid of Square, right?
Yep.
That means the balance of shares in the hands of the minority shareholders called NCI
1.8
is 20%. So 20% of 9 million will give us the number of shares in their hands. Then what do? We multiply that by what? By the market price of subsidiary Square share at the date of acquisition, which is 3.5. Are you saying we've not done this before? We've done it. We've solved this stuff.
Yeah. That was the attempt I wanted to make now, Mr. Adami. But you got discouraged when I said I wanted to attempt.
And the way you sounded
Everything
that.
is attempts in this ACCU. You can just attempt. You pray and hope.
You should stay with confidence. The fact that you said it without confidence is what really made me to be scared. Okay. So we've got the first item. We'll get the first item with that, right? Maybe I should go straight to start doing it. Question 6. What we are asked to do there is NCI in Square at the day, at the reporting day, right? At the reporting date being 30 September 20x5, right? And in doing that, we're going to start with fair value of NCI at the date of acquisition. The number of shares is 9 million from what we saw. NCI percentage is 20%. And the market price of the share of the subsidiary at the date of acquisition is 3.5. So we say equal 9 million multiplied by 20%, then multiply by 3.5. That gives problem with this. Okay. Use this thing for something else before. Okay. Then the second thing is NCI's share of pari. We all know the meaning of pari, post-acquisition retaining of who? Of the subsidiary, right? Let's now go back to the question. You and I know that in all the practice questions we solved involving preparation of consolidated SFP, We will do some key working notes, one of which is net asset of the subsidiary, right? Where we will have 3 columns: at reporting date, at acquisition date, and post-acquisition retaining. If we do that working note correctly, right, that last column, which is the post-acquisition retaining, the total is what we always pick to come and multiply by the NCI percentage to get the second item here, right? You remember that. However, you know, this is not a full practice question, and we've not done net asset working out. So what we need to do, we are not going to worry ourselves with full net asset working out. Or if at all we want to do anything similar to that, it will only just be that third column, which is the post-acquisition retaining, that we'll focus on. If you remember, in that column, what always comes there is the first thing that comes to that last column is the retaining at the reporting date, right? Minus retaining at the date of acquisition. We bring it there. Then we'll now look at all the adjustment that affects that post-acquisition retaining, and we'll bring them there. And that is how we get the total. If you go back and check any of the questions we've solved before, that is what you will see there. So let's go back to the question. Acquisition was 1st October 20S4, right? Reporting day is 30th September 20S5. So that means we are not dealing with acquisition during the year. We are dealing with acquisition at the beginning of the year, right? So that's part of our affairs. Our affair has been allayed then. In answer, at the date of acquisition, SquareCo had an item of plant which had a fair value of 3 million in excess of its carrying amount. That is fair value adjustment, right? You know, ordinarily that one does not affect profit. Fair value adjustment affects the date of acquisition column in that net asset. But let's now read further. At the date of acquisition, it had a useful life of 5 years. What should be going through your mind then is additional what? Additional what?
Depreciation.
Exactly. That is what should be going. That is what will reduce our profit. That is one of the adjustments that we have extend to the post-acquisition retaining column. Pyramid co policies to value NCI at fair value at the date of acquisition. For this purpose, SquareCo shares had a value of 3.5. In the year ended 30th September 2025, SquareCo reported a profit of what? 8 million. So post-acquisition retaining before any adjustment is 8 million. Do you agree with me? Post-acquisition retaining before any adjustment is what? 8 million. The only adjustment that will reduce that is the additional depreciation that will be calculated based on that fair value adjustment of 3 million. Given that the useful life of the asset is what? 5 years. So we'll say 3 million divided by 5, multiplied by 1. That will give us the additional depreciation to be deducted from 8 million, such that we have, let me leave a line. So there are just 2 items coming there. At the end of the day, whatever we get there. So let me say working notes. Working note. I will say working note A. I will label it A. So this, I want to calculate post-acquisition retained earning of SquareCo, which is the subsidiary, right? Subsidiary after adjustment, right? After adjustment. Then, so we'll start with profit for the year at the question. That is 8 million, according to what we saw. The next thing is additional depreciation on plants. That would be simply the 3 million divided by 5, then multiplied by what? By 1. So equal minus 3 million divided by 5 multiplied by 1. And that takes us to where? It takes us to 7.4. Then I come back here and say that's 7.4, right?
So what are the fair value adjustments?
Does that always affect your retaining? You only use that to calculate. That is why I said go and check any. Unfortunately, the Excel I'm using here is different from the one I've used to solve all those questions for you. Fair value adjustment, we put it in the column of at reporting date and in the column of at acquisition date. Do we always extend it to the post-acquisition retaining column? That is the question I'm asking for you. You know, this working here I did here is the post-acquisition retaining column. Do we always extend fair value adjustment there? I want you to answer that question first. You
No,
must
sir.
answer me.
I've seen it.
So we don't extend it there. So it's not going to affect your post-acquisition retaining figure. 20% is the NCI percentage. So I will say this figure times 20%. Oh, is NCI percentage not 20%? I hope
Yeah.
I'm not calling. Is it 20%?
Yes, please.
I hope I'm not calling something from my head. Okay, the correct answer is what? Did you not see it? What we did there? The correct answer is C, 7780. 7780. Can you see 7780 here? The correct answer is C. The correct answer is C. 7. Chinelo, you raised your hand, but your hand went down. Was
Yeah,
that
I wanted to ask a question, but maybe sort of I would say maybe you've cleared, because I was thinking that the 8 million was was more of Square's share of the profit already. And maybe we didn't have to do any other adjustment on it. And I was expecting that the only adjustment should come to the depreciation side, but I think it's clearer now.
Because if you look at it, if you look at the statement they made here, it said in the year ended 30 September 2025, Square Co reported a profit of 8 million. The profit of 8 million. So that can be.
Yeah, so it didn't specify it was Square Co's share. It's okay. Thank you.
Okay, so question 7. Question 7, please. Emmanuel, you can't be tired until you've done like 10 questions. So.
Sorry, can you just go to the Excel sheet for a minute, please?
But hope you know that this Excel sheet will be sent to you.
I'm aware. Okay, thanks. I'm done, please.
Question 7. I press Emmanuel is tired. Chinelo, you want to read?
Okay. Pact acquired 80% of the equity shares of SACT on 1st July 2014, paying $3 for each share acquired. This represented a premium of 20% over the market price of SACT's share at that date. SACT shareholders fund as at 31st 2015 were, I don't need to read that. The only fair value adjustment required to SACT's net assets on consolidation was a $20,000 increase in the value of its land, PAC's policy is to value non-controlling interest at fair value at the acquisition date. For this purpose, the market price of SAC's share at that date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. What will be the carrying amount of the NCI of SACS in the consolidated financial position of PACS as at 31st March 2015?
Sorry, Mr. Jami, I have a question. So I'm looking at the requirements of number 7, and I'm looking at the requirements of number 6. Is it the same thing? Are they the same thing?
The requirements of question 6 and question 7, you are asking whether they are the same.
Yes, sir.
Yes, they are the same. It's
Okay.
NCI that want us to calculate the two.
Okay. Because one was saying what value would it be recorded at? Okay, yeah, it's the same thing. Okay, thank you, sir.
It's the same. But unlike the other question 6, this question 7, if you count from 1st July 2014, are we together? To 31st March 2015, 31st March 2015 being the year end, how many months do you have in there?
9 months.
9
How many
months.
months?
9.
That means we are dealing with acquisition during the year here, right? Unlike the other one. Here we are dealing with acquisition during the year. Okay. So if the requirements are the same, right? It means I can borrow the format of that, what I did here. I can borrow the format. What would be different is the figure, right? I can borrow the format, which I've just gladly borrowed. And I will change the date to 31st March, right? 31 March 20x5. And I will change the name of the company to SACT, right? SACT. Yeah. And I will change the figures, right? I will change the figures until I'm able to figure out its own figures. So, okay, so I already have the format there. Going back to the question, we need 2 items. The first one is fair value of NCI, right? NCI percentage is 20% as well. And what is the number of shares? Such shareholders fund as at 31st March 2015. Oh, so NCI share of the number of shares at the end of the year is what it says. It's 2015, not S5. So at the end of the year, is 100,000. You know, this equity share of $1 is 100,000. And they did not tell us that the share capital has changed, right? That means the share capital at the end will be deemed to be the share capital at the beginning. Remember, of course, for ECC group accounts, share capital of the subsidiary at acquisition day will always remain the same as share capital at the end of the year. It won't change. You won't see an instance where it changes. It will not change. So because it's not going to change, right? So we'll take this $100,000, divide it by $1. That gives us 100,000 units. We are supposed to multiply that by 20%, just like we did in the other question, and multiply that by the market price of the subsidiary's share at the date of acquisition. But is that one given? Is that market price given? Is it given? Can you see where it's given here?
Yes.
Oh yeah, tell me how much.
No.
Tell me how much.
$3.
$3.
Eh. Is that what
No.
they mention as the market price?
I think it's the premium of the 20% over the.
You know what Pact is the parent. What it paid to acquire its own share was $3. Is that not? Is that not what that first statement is saying?
Yes.
It paid $3. But does that mean the market price of the subsidiary share was $3? No. This examiner is very tricky. It's not. It paid something higher than the market price. Isn't that what we saw here? It says that $3 that this guy paid represents a premium of 20% over the market price of SAC's share. What we are interested in, that we must multiply by 20% of 100,000 units, is market price of SAC's share, not the amount that Pact paid. We're interested in the market price of the share. How will you derive that? This examiner is bad, and this is a past question. The past question.
Would that be 80% of 3?
Oh yeah, just tell me the figure you have. When you say 80% of 3, I don't know how you want to derive that, but tell me the figure you have. Call your figure, Chinelo.
2.5.
2.4.
I got 2.5.
Chinelo, what did you say you got? 80% of 3 will not give you 2.5 for.
No, that's someone else. It's Sybil that's talking.
No, that's
Okay.
okay. I think it's 2.5 too.
You think, how did you arrive at that? Tell me. For those
Because
of you
I
got
know
to,
that it means that that $3 is 120%. So I'm looking for the 100% of it.
okay, fantastic. I love the way you explain it. That 3 is 120% because a premium of 20% had been added. So you are looking for 100% of it. If I take it the way you've explained it, I would say that 3 divided by 120 times 100, right? And that will give you how much? 2.5. 2.5. Another way of getting the same thing is to say, yes, it's 120%. I will now gross it down. Gross it down. So I would just say 3 divided by 1.2. If you divide 3 by 1.2, it will give you exactly 2.5, which is another way of doing it. You are grossing it down. So, so we do that. We do that to get. Then this company was acquired. Return earning at the beginning of the year is 80,000. That is entirely free. We are not interested in that. Profit for the full year. For the year ended, you know they say year ended. This 40,000 is not 9-month profit. It's profit for 12 months. But you know our post-acquisition period is 9 months. So we'll pick this 40. We multiply it by 9/12. And we'll multiply it by 20% at the end of the day. They said there is a fair value adjustment, just like we had in the other question. But for this one, they say it's attributable to what? Land. Do we depreciate land? The answer is no. So there is nothing like additional depreciation, unlike what we saw in the other land, in the other question. So it's the same requirement as question 6, but the requirement, the contents differ. The contents differ. You can solve 20 questions, all of them talking about calculating carrying amount of NCI. But you will see that we'll be doing it differently because the contents of the questions differ. Okay. Let me go and do working one. Let me just borrow this thing here. So I'll say working A again, or label A. What am I doing here? I want to determine market price per share of SAT share at acquisition date, which is 1 July 2014, right? And thereafter, I will now say amount paid by parent company for each share of SAC, right? That is 3, right? That is 3. The guy paid 3. I will now come down and say market price of SAC share, right? That should be that 3 divided by 1.2. So equal this figure divided by 1.2. Oh, okay. I need to. So that takes me to 2.5, as you can see. So fair value of NCA at the date of acquisition is 100,000 shares. They multiply by 20%. They multiply by 2.5, right? Equal 100,000 times 20% times this 2.5. Then the next thing is unrealized, profit for the year that we saw there. I remember is 40,000, right? Is it not 40?
It's
Times
40,000,
9
sir.
at 12, and times 20%. Equal 40 times 9 divided by 12, and times
20%.
20. That is 6. So that is 56. Do we have 56 in our option?
C. Let's just do CCC for everything. Everything is looking like CCC. Oh, Mr. Jami, sorry, I wanted to ask this second column that we have 100,000 and 120,000. What's it speaking to?
Say 100,000 and 120,000.
The column beside that one that has 80,000 and 40,000. I'm wondering what it's talking about.
No, I can't see what you are talking about.
Yeah, it is in the question. No, when we are solving the next question, we'll see it.
Oh, okay. In the question. Is it 80,000? I explained this now. Are you talking of this 80,000?
No. The 100,000 and the 120,000.
Share capital now. This is share capital.
Oh, okay. Then
And
that's
the
the profit of
120,000 is the summation of the profit at the beginning of the year plus profit made during the year.
Oh.
Can't you see?
Thank you for
And the only one we are interested in is that 40.
Okay.
Okay, it's 11:09. Obviously, there's no way I can finish these questions. That is the fact. I can't finish. I must have been misled by whatever has misled me, thinking that I'll be able to finish the entire 27 questions and still solve practice questions. We spent more than 2 hours now, although we didn't start exactly the time because some of you didn't join the class on time. So let's pause. Let's go for break. This is 11:09. Let's go for break and come back by 11. We do 15 minutes, right? 11:25.
Okay.
Let's go for break and come by 11:25. So when we come back, I will tell you how we will proceed. Thank you.
Okay, sir.